Right now in India, thousands of businesses are locked in this massive, high-stakes battle with the government, and it all started with a sudden policy shift. It's a huge story about a major tax reform, some pretty serious unintended consequences, and a legal fight that is literally worth billions.
And this is the number that kicked the whole thing off. 2,500 crore rupees. That's the absolutely staggering amount of money at the heart of this whole dispute. We're talking about money that businesses had in their accounts one day, and the next day they woke up and found it was basically unusable.
So, who's in the ring for this fight? Well, in one corner, you've got thousands of the country's automobile dealers, all represented by their national federation. And in the other corner, the government of India. It's a classic showdown, really, sparked by a sudden policy change that had a huge, immediate impact.
Okay, so let's set the stage. How did this 2,500 crore rupee problem even happen? Because, this isn't just some abstract number on a spreadsheet. It represents real, hard cash and the financial stability of thousands of businesses all across the country. The group that's really leading the charge here is the Federation of Automobile Dealers Associations, or FADA for short. And these guys are the voice for over 15,000 dealerships. The core of their problem is that 2,500 crore rupees in tax credits that were just sitting in their members' accounts. Credits that were made pretty much obsolete overnight thanks to a major tax reform.
Now, to really get what went wrong, we need to quickly break down how the tax system was supposed to work. It's all under India's goods and services tax, the GST.
First thing you gotta know about is something called the Compensation Cess. The easiest way to think of it is just an extra tax, kind of like a surcharge, that gets applied to certain things like cars. It was brought in back in 2017 with the whole GST system, and the idea was to use this extra cash to help out Indian states that might lose money from the switch to GST. Simple enough, right? And the second piece of the puzzle, and this is absolutely crucial, is the input tax credit, or ITC. This is really the heart and soul of the entire GST system. The best analogy is to think of it like a prepaid store credit. So when a business, like a car dealer, buys its inventory, it pays tax on it. The government then gives them a credit for that tax amount. Later, they can use that credit to pay the taxes they collect from their customers. The whole point is to make sure you're not paying tax on top of tax. It keeps the chain clean. So here's how it worked for a car dealer, step by step. First, the dealer buys a car from a manufacturer, and they pay the regular GST plus that extra compensation cess. Step 2, in return, they get that input tax credit for the cess they just paid. And finally, when the dealer sells the car to you or me, they use that prepaid credit to pay the cess they collected from the sale. It was a nice, simple, circular flow. But then came the plot twist. The government, in a move to make the tax system even simpler, which is a good goal, introduced a major reform. But this well-intentioned move, it ended up throwing that whole system into absolute chaos for these auto dealers. The big change happened on August 15, 2025. India's Prime Minister announced something called GST 2.0, and the vision behind it was simple and pretty ambitious. Let's streamline the tax system, boost the economy, and just generally make life easier for everybody. And GST 2.0 brought some really dramatic tax cuts for cars. I mean, just look at this. The total tax on a small car dropped from 29% all the way down to 18%. For big SUVs, it fell from 50% to 40%. That's fantastic news if you're buying a car. But notice what's missing in that new rate column? That's right, the compensation cess. It was totally abolished for cars, and that is exactly where the problem started. And here it is. This is the absolute heart of the crisis. When the government put out the official order, it just said, here are the new tax rates. But, as this quote points out, the order was completely silent, totally silent, on what dealers were supposed to do with the crores of rupees in cess credits they already had. There was no plan, no transition period, nothing. The result was, honestly, immediate and brutal. Since that compensation cess tax didn't exist anymore, the credits that were specifically designed to pay that tax, they became instantly worthless. Dealers couldn't use them. That massive 2,500 crore rupees, their prepaid tax credit, was just stranded, locked up in their accounts with no way to use it or get it back. So, with no other option on the table, the dealers did the only thing they could. They took their fight to the highest court in the land, the Supreme Court of India. And just like that, a tax policy problem turned into a massive legal showdown.
So on October 17th, 2025, FADA made it official and filed a writ petition. And this document you're looking at here, this is part of that actual filing. This wasn't just a complaint anymore. This was a formal constitutional challenge to the government's actions. When you strip away all the complicated legal jargon, this entire multi-billion rupee case really hinges on one powerful question. Is a tax credit an unbreakable right, or is it just a flexible concession from the government?
So here are the two sides of it. The dealers are arguing that once they earned that credit, it became their property. They call it a vested right, something that can't just be taken away. On the other hand, the government's position seems to be that these benefits are more of a conditional concession, basically a privilege that's granted by a policy, and if the policy changes, so can the privilege. The court's answer to this is going to have huge ripple effects on tax law in India.
So where does this high-stakes case stand right now? Let's take a look at what's happened and what's coming up. Okay, so the first big move was on December 15th, 2025. That's when the Supreme Court officially took up the case and sent a notice to the government saying, you need to respond to this. The next key date to watch is March 25th, 2026. That's the deadline for the government to file its side of the story. After that, the court will hear the arguments, and eventually its final ruling is going to set a major precedent for years to come. And this is exactly why this case matters so much, way beyond just the auto industry. See, if the court sides with the dealers, it could create stronger protections for all businesses against sudden, costly policy changes. But if it sides with the government, it could give them more power to change tax schemes on the fly. At the end of the day, this ruling will help define the balance of power between all taxpayers and the state. So as we wait for that final verdict, it really leaves us with this one fundamental question. Look, we all want simpler, better policies, right? But when a government makes a big change, even for all the right reasons, who should have to pay for the bumps along the road? Is it the businesses who get caught in the middle, or is it up to the system itself to absorb that cost? That's the core dilemma that the Supreme Court is now trying to solve.